All right, good morning. Good morning to all of you. And thank you for joining us this morning on our market direction talk for second half of 2021. My name is Stuart Cheng. I am the co-founder for Navis and a senior associate executive director for Orange Tea and Tide. So welcome to you. And well, I hope you had a great morning, brought along your coffee or a nice drink to accompany you and me throughout this probably 1.5 hour session if we are lucky. All right. So I have so much to share with you today, and I'm very excited to do it. And thank you to those of you who have also invited your friends here to listen in, and my friends also listening in from Singapore, Australia, many friends around the world who are and in Singapore who wants to know what exactly is happening in the market. What are the trends telling us? Because all of us are so busy living, working, that we always lose track of too many things. There's just too many things in the market to keep track of. And sometimes the news comes out to scare us. Sometimes you read about, wow, fantastic news. So which is real, which isn't, and which is just media hype that we need to cut through the noise and look towards the root of what's happening. Okay, so in today's session, I'll cover a few main points. First, as you can see, is the macro to micro trends that are giving investors clear signals for the midterm. Are the risk to rewards ratio still worth it for you to start entering the market? What can you do? What are your options? Right? Are further cooling measures likely to happen soon? And are there any high probability of profit projects to invest in today? Because ultimately, you want to know where the opportunities lie, right? And of course, if you're just a first timer, you're an upgrader or an investor, what other options do you have for yourself? Okay, so I hope this session gives you some insights into what we in the market are doing every day, how we look at the pulse of the market and all the trends. Okay, so let's begin. I just give you 10 seconds to read this very interesting disclaimer. Okay, as usual, this is an investment talk. This is our opinion. Please seek your own advice, whether legal, financial advice, before taking the plunge into any decision. Okay, let's move on. Now, a recap. If you followed me during our first half 2021 talk, you will know that I mentioned studying history so that we understand how people react, how governments react, and how markets are likely to react. After all, markets are made out of who? People, right? So people react a certain way in fear, in crisis, in a rebounding market. And in the first half of the year, this is what I shared. So a quick recap for those of you who can't remember or missed it, okay? So this is what happened. Well, the Federal Reserve begins printing money in Q4 2019. We saw the US market stock rally in Q2 2020. And similarly, from whether it's the global financial crisis or prior to that, even in the Asian financial crisis, there's a certain thing that happens in the US that triggers things that happen around the world. Why? Because it's like from a mountain it rains, right? And this rain is like money. When money supply comes into the whole market, it flows down from the mountains, down to the rivers, to the streams, and finally to the ocean. So we being so far away, and of course, being one of the beneficiaries of money printing, if you're an asset owner, we receive it only at the end. Probably we're in the stream or in the ocean, and we start to receive all these asset price growth as a result of money supply. Okay, so what happens next was in Q2 2020, Singapore stock market rally, and then we predicted, well, 5 quarters later from this date, okay, the Singapore real estate market should rebound, and rebound it did, and really strongly, as we saw. Okay, quite a surprise, right? Because COVID was supposed to be really bad, but well, it became a really good time for those who are in the property industry and property owners. So since then, what has happened to the STI? For those of you who, well, I have shared before, those who know me, I'm a very avid trader in the stock market, in the US market, Hong Kong market, in options, in real estate. So I like to compare with, these different markets to understand how the dots join up, how the dots align. And because of that, I'm able to see much further ahead, or have some forecasts ahead of the market about what's going to do next. So this is the STI, Straits Times Index. Since our bottom, it is now back to pre-COVID levels. Okay, you can see it's back to pre-COVID levels. This was pre-COVID. This is where we are roughly at now. Okay, so things are almost back to normal in terms of the stock market and wealth in that area. Okay, and for the S&P 500, for those of you who know, this is the major 500 companies in the US. They represent a lot of the economy, and they have gone beyond the past peak in prices, up 26%. And what is important here to understand, why do all these markets affect the real estate market in Singapore? Isn't that too far-fetched, Stuart? Well, because wealth and money flows a certain way. When there are people making money from this period of time, guess what? They will diversify. People will not keep all their money in the stock market because you can't really enjoy the stock, right? You can't enjoy the stock like you enjoy a property, facilities, bigger space, especially needed now that you can't travel. Okay, so we study all these to understand more. So a recap once again, at the start of the year, I mentioned that, well, the STI is a leading indicator of the property market. As you can see here, every time, okay, all these shaded areas in gray, okay, shaded in gray, you can follow me here and just take a look. In 98, for example, when we start to see the STI moving up over here, about another 1 quarter later, you see the PPI. The PPI is a property price index moving up. Now, next, what happened? In this case, in 2003, when we start to see the Straits Times Index moving up, a couple quarters later, a bit longer though, about 6 quarters later, we saw the PPI also moving up. Okay, the other side of it is this. Is 2009 this year, where we saw end of 2008, where we saw the Straits Times Index picking up, and we saw in the first quarter of 2009 the property market picking up. Okay, so there are a lot of correlation because of how money flows. And usually the stock market reacts first. When the markets drop like last year in COVID, what happened? Right, what happened? The stock market dropped very badly, right? Property markets are not so volatile, so they take time to react. Similarly, when markets pick up, property markets also take time to react because the turnaround period is a lot longer. So in the most current years, right, of what we saw is 2016, when we saw the STI picking up. It took a few quarters before we see a pickup in the property market. So once again, we see a pattern here. So we study patterns to tell us about behavior, where money flow is likely to go to. So, and we estimated at the start of the year that the PPI sees significant gains 2 to 3 quarters after STI recovers, and we estimated that this will be a great boom time. And indeed, it was also one of the greatest boom time over the last 2 quarters. And history repeated itself. You can see here that in this circle, this area, we can see that the property market has picked up a lot. People are not traveling. They need more space, to work from home. They need space for their kids, and for spouse to survive each other, they have to get a bigger space, right? So now we see a lot of upgrading. So serious buyers, people who really need a space, are buying houses. Okay, overall, the residential market is made up of 2 segments, and today we will primarily cover residential market. And the reason is simple: most of you are residential owners or investors at least, and a few of you might be commercial owners, industrial owners, but it's not the major thing right now for most of the buyers or interested investors. So we'll focus on these 2 areas. And if you're a HDB owner, you would have been seeing 6.2% growth in the last 2 quarters. See over here, the red line. Okay, the red line is HDB. The blue line is the private property price index. Well, both markets have grown a lot in the past 2 quarters. And that's very good, very strong market, buoyed up by the HDB market. All right, because in the past few years, we have seen the HDB market being a downward move for many years. Okay, from 2013 all the way up to around 2019. Before the stimulus in September 2019 came out by HDB to pump more money into every HDB owner's hands, because when they sell, a buyer is going to pay you more because of the grants they have. Okay, more importantly, over the past 6 months, okay, an average HDB flat of 500K, that's around the median price in Singapore, to an average condo price of 1.2 mil, each have gained, and by different amounts, obviously, because the denominator is different. Okay, so the 500K HDB will have seen an appreciation of 31,000. An average size 1.2 million condo will have appreciated by $67,000. Now, some people are also concerned that, hey, will the HDB market be cooled after so many years of waiting? Finally, my friends are cashing out at a profit. Some of them are finally cashing out without CPF accrued interest after many years of wait. And people are worried that, hey, if I wait a little longer, will the government cool this market? Well, it is my take, okay, from our own graphs generated by Navis research, and also all these data are by data.gov.sg, official government data. It seems this time round that the price growth is moderate. Although in the last 2 quarters, it sounds very frothy. It sounds like it's a strong growth, but it is not a bubble yet. You can see the Hdb resale index, the blue line this time, okay, versus household income. In the past, from 2006 all the way up to this point where the major cooling measures came in 2013. Within this point, we saw very strong growth in prices, the blue line, okay, but not so strong growth in the red line. Okay, and because of that, the government has been doing a lot to cool down in the past. Okay, because the gradient of growth is a little bit too steep for people to accept. Because prices keep escalating, the young people cannot settle down, and owning a home becomes an issue, and that becomes a social issue, right? So currently where we are is this box over here. Okay, we have seen how prices grew. Yes, no doubt there's a moderation in our income since 2020. Why? Because obviously COVID situation. Okay, but it hasn't grown by too much. Neither has income fallen by too much. So we are likely to see that more HDB sellers will be cashing out on this wave, and further down in the next 1 or 2 years, most of them will be cashing out because they finally cash out without CPF accrued interest. They finally can cash out for a decent profit to upgrade to a private if that's what they want to do. Most people do that. Okay, and this is likely to further fuel demand for private properties in the next 6 months. It's very likely. So far, the demand is very real. People sitting on too much cash and know that inflation is eating into their money. They know that the governments across the world are all targeting a high inflation to get out of this current crisis. And of course, fueled by local demand, aspirational demands. Okay, so that's for the HDB market. How about the private non-landed index? Private non-landed index basically means the condos and the apartments, okay, versus household incomes. Now we can see how in the past, okay, since 2006 all the way to 2013, okay, you can see that the PPI has went up quite a lot, and incomes were nearly aligned in growth. Okay, but despite that, right, prices were a bit too frothy in certain years, especially when the growth was very steep. Okay, so the government did cool down the market, as we know, in 2013, and since then, property prices made a dip. The private property prices made a dip, and only staged a comeback in the past few years, since 2017. Okay, so in this area, what we see is there is still a risk of cooling measures. There's still a risk, although government came out on the 30th of June to say that we are monitoring the market. We are not yet implementing any measures. We don't think that is frothy yet. Okay, but there could be measures for the second property due to some reasons I will explain later. I will show you some affordability ratios that we have come up on our own. In the past, it tracks when cooling measures happen, so it might help you to have your own decision that you come up with. Okay, so there are no signs of a bubble as yet because private non-landed prices are not escalating too quickly as of now. Okay, so that's good to know too. Now, this is the one I mentioned to you, the probability of cooling measures in 2021. It is still high. Okay, and it's it's pretty a lot of data on this. But in this table, we study the year, of course, PPI, the amount of growth per year, the median income. Okay, because income is definitely one of the criteria that the government looks at when determining whether prices are frothy or not. Okay, median income growth by percentage. And then we have an income to PPI ratio. Okay, so this ratio is we take the PPI and do it as a fraction of median income, and we arrive at certain figures. 57, you can see 57, 53, 43, 52, and so on. Okay, so just bear in mind for a while. Then we see a gain or drop in affordability, because any rapid drop in affordability is an issue. It means that prices are going out of control. Prices are probably going too much ahead of fundamentals, and government will likely cool them down. Okay, so in certain years we see cooling measures, in certain years we don't, and I will summarize it afterwards. What we can expect to see in this year, okay, or in the coming months. So measures, okay, the measure summary is here, and whether it's an election year, well, it's just for study's sake. Okay, so point number one, whenever there's a high probability of cooling measures is when there's a drop in affordability. And you can see in certain years, okay, like for example, in 2007, when there was a drop of 18%, which was a drastic drop, and the income to PPI ratio became 43. All right, less than 50. We saw cooling measures, okay, coming in. And in the further years, okay, as the government tried to, from this measure, try to warm up the market, try to cool the market and let incomes catch up, right? It did improve. And you can see over here from 43, it went to 52, the ratio. And then from 52, it went down again in 2009 because prices escalated pretty quickly after that. So at that point, affordability started to drop again, and in the following years, and that was when cooling measures start to come in. Cooling measures, because once again, the PPI ratio starts to drop to below 50. Okay, so fast forward a few years, we saw that in 2017, okay, there was easing measures, one of the rare ones, where the SSD from 4 years, it was reduced to 3 years, right? If you remember that, from 4 years to 3 years. And why? Because the market then, the affordability was pretty okay then, was around the 60 plus region, 67 region in this case. So at that stage, there was space to ease it. And developers who were over the past few years as invested abroad in Australia, buying buildings in Japan, in Australia, in Vietnam, in US and UK, right, started to come back here and bid aggressively for land because they saw that as a signal of government easing measures together with incomes catching up. And there was a shortfall of supply coming up. Okay, so and then what happened in 2018? We saw that affordability started to drop by 5%, which was a little bit too much. It came back too fast. The market came back too fast. Some cooling measures were enacted. Okay, and then what happened next was 2019 is a normal year. There were no measures. 2020 affordability dropped by 7%. Now the ratio was 59. And next, so far, 2021 year to date, from what we know, it's dropped by 3%. So we're at 57. And given that these 2 years of drop in affordability is a total of at least 10% by now, this is quite a severe drop, and there's likelihood of cooling measures coming in. But of course, when will it be? MES will not announce in advance, right? Okay, and what will it be? No one knows. Okay, whether it will be first, second, third property, no one knows. But likelihood only on multiple property owners. Okay, so if you're a multiple property owner and you are looking out for property, you know what to do. Okay, income versus point number 2, income versus PPI ratio when it drops rapidly, or when the income to PPI ratio is 52 or below. This is what we usually see. So based on this so far, we find that there's still a high chance of cooling measures happening, and it's also very much subjected to what happens in the next 6 months this year. The last month of a mini circuit breaker, right, has also given the market some time to cool off. But it's likely that with the the way things are about travel, construction delays and so on, it's still very likely that we'll see the market picking up strongly because there's still so much demand that remains unsatisfied. Okay, so next. Now, talking about holding power, because as prices go up, there's always this question: can people afford it? Is this a case where you pass the ball under the music stops, and then people start to collapse under debt? Well, you can see here from the past history, right, that in the blue line is the household net worth of typical residential households, and the blue line is very, very strong. It has grown a lot over the past few years, especially since 2013. Okay, so the prudence of TDSR, total debt servicing ratio, the prudent policies of the government about lending have helped household incomes to shore up their balance sheets. Generally, most households are getting an increased salary every year, median salary. So that also helps to make sure our market is strong fundamentally and can resist any sudden shocks to the market. So far, this is what we see. Yeah, there is no risk of people dumping properties like in the case of AFC during Asian financial crisis or global financial crisis. All right, next, can we expect further growth in the market in the next few years? Okay, so let's take a look at a few things. I also want to introduce you to money supply. Okay, M2 money supply is the amount of money in the market. And this is important to understand because inflation is all about printing more money chasing after the same number or less goods and services. So when there's more money being printed and less services or goods supplied, you get this issue. Things get more expensive. Okay, around the world, this is what we are facing now. The impacts on our shores have also been reported over the past few months and is likely to continue. Okay, so you can see a very steep growth recently. This is the area we are in now. A very steep growth since the Federal Reserve in the US started printing money. Well, globally, when US is still the big boy in the market for now. So when they start to print money, the world starts to print money. Okay, the fact is, if you don't, your currency might appreciate too much. If you don't balance it out, your currency might appreciate too much, and you might have an issue of people can't afford to import your goods and services from your country. So there's balances that need to be adjusted. So we can see that every time there's an increase in money supply in certain years, for example, recently, okay, for example, you can it's a little small, but you can see that it's an artificial curve upwards. Whenever this happens, you can see how private non-landed markets and landed markets react. They move up whenever there's money printing. Why? Because cost of funds are cheap, all right? And people who are savvy investors know that whenever the world prints money, right? So far, historically, a money printing episode, you can see a very artificial steep curve here, is leading to an asset price inflation. So far, this has happened. Okay, this is also pronounced here. You can see in this area where there was money printing post AFC, and then this happened. Okay, and of course in this area when there's money printing, it took a little while for the markets to react, but in this case, a few quarters later. Okay, so we have to understand global economics and we have to apply them to where we are, because we are still a very small country, like a grass in the wind. Whatever happens, the wind direction changes, it affects how our assets move in prices. Okay, and you also want to know whether it's safe, whether this party will be prolonged or it will be cut short anytime. Chances are, so far, it has to carry on. Okay, so price indices across different residential segments. We have the blue line being the non-landed property price index. We have the red line being the landed property price index, and then the Hdb Resale index. And recently, okay, you can see from here, recently, all three markets are showing congruence. They are all moving up in the same direction. Okay, it's very steep, the landed being the steepest of all. So for those of you who are looking for landed or have been searching for landed or have bought a landed, you would know that prices these days are very high. Okay, so in these three areas, what we can see are, if you compare it horizontally, okay, the red line. So we have the landed market. The landed market has exceeded the past high. Okay, the blue line, the non-landed market, the condos, have also exceeded past highs. Okay, but the Hdb market has not. It's still below the past high, the yellow line. Okay, the yellow line being here, and currently we are here. So it's very likely the Hdb market will be given more space to grow, given a lot of people are kind of upset that, in the past they were promised that their Hdb will be an asset that helps them in retirement. But as time passes and tenure decay happens, right, a lot of people are saying that, hey, my Hdb has been declining or stagnating over the years. How am I going to cash out, or how is it an asset to me? Like long ago, many years ago, when the government promised them in some speech, right? So it's very likely that this time round, from my opinion of things, that the government will allow the party to carry on for HDB market in one on one hand to help the economy, because a lot of people who are who if they lose their job or they need to be reskilled for another job, they might sell their home in order to right size, to downgrade, so that they can have some cash on hand to do something. So allowing the market to move in this way and allowing some appreciation would allow a different market to benefit from it. And at the same time, of course, HDB owners haven't been too pleased that over these 7 years, there hasn't been much growth. And finally, now they're seeing some growth. It's very unlikely that government will take this away from them too soon. Okay. Furthermore, the stimulus effects are still there, because in September 2019, when the stimulus was announced, in the following few months, COVID struck. So money hasn't moved from policy to people's pockets yet. So it still will have some ripple effects down the road for the HDB market. And as we know, in the recent 2 quarters, most of the buying has been done by locals, by Singaporeans. Most of it. There are some foreigner buying, but not so much, as they can't travel to see it, right? Only those who are buying off plan, generally. So most of them are local buyers, meaning the current growth in prices in the private landed and non-landed sectors are driven primarily by upgraders. What we see is a flow of funds from HDB upgraders upgrading towards condos, condo owners upgrading towards landed owners probably upgrading towards GCBs. That's why we're seeing the markets all moving upwards. And it's very fundamentally driven, and it should carry on, barring, of course, buying second, third properties, where we mentioned earlier, are likely to face more cooling measures. Okay. So post-crisis, how much higher did landed homes exceed in the past? Okay, so that we can use this as an attempt to predict the future. And predict it is, because no one can get it right. No economists, no analysts will get the right number. So we are all making the best guess we can, so that we know whether to take more risks with our money or to hold back our horses and to wait for a correction. Okay, so during the dot-com bubble bust, the peak of market here, we saw that from this point to the global financial crisis, not the great financial crisis, okay? The global financial crisis, the peak went up by 16.6%. Okay, from the global financial crisis to our severe cooling measures, okay, without which the market wouldn't have come down, it would have spiraled out of control. Okay, it went up by 52%. Okay, for landed market. So in this time round, from this peak of 2013 to where we are now, currently here, it is only a difference of 3.6% higher than the last peak. So is there a chance that it will go beyond this? Well, it appears so. Okay, we can't guess, of course, that will this time round be 52% or 16% or half of 52% or 1/3 of, nobody knows. All right, but there is a high chance that it will go beyond that. That means 3.6% is just the starting of a bull run for the property market. It's just a starting point. There's a high chance this could go into the 10s, into the 15s, into the 20s. Yeah, that's my own view of the market, based on how equities have also grown beyond their valuations since pre-COVID times. Okay, people are paying multiples of earnings for businesses. If they are finding it too expensive, guess where they will put their money next? It's all about, in a way, sector rotation. From stocks, it moves to somewhere. It moves to real assets with lesser volatility as part of the diversification plans. So real estate is definitely one of the beneficiaries. Well, you have your crypto, you have your gold, but it's very volatile. And of course, gold isn't performing as well. So properties are the next best place to be. Okay, next, let's take a look at how did the non-landed markets perform in the past highs. Okay, we see that since the dot-com bubble bust, it went up 28.5% peak to peak. All right. And then from the global financial crisis, it went up 11.5% to the 2013 cooling measures. And currently, where we are now is we are only 5%, 5.5%. Okay. Once again, the past does not automatically equate. Just hang on. I think the slides have stopped moving. Yes, I think the slides have stopped moving on your side. Just a minute. Let me check on this. All right, just hang on. I'll just reset my Zoom and then let's come back to it. Somehow my live broadcasting failed midway. Okay, great. We are back. Okay, thanks for your patience. So we are back here for the non-landed market. As I mentioned earlier, the last peak was, the dot-com bubble bust to global financial crisis. It went up by peak to peak 28.5%. From the global financial crisis to the severe cooling measures we had in 2013, it went up by 11.5%. And finally, right now, we are only 5.5% into exceeding the last high. Okay, so is there still higher increment this time round? Well, I had a chat with some of my friends. They were saying that, hey, last round was 11.5. This time round, it may be half. So we are just nice about 5.5%. So who's to say how much it will grow, right? We have to look at fundamentals. Of course, we have to have the blessings of our government, right? Government ultimately controls the policies. But as of now, with household incomes being so robust, with net worth being robust, employment rates generally are still okay. It's not very strong, but at least it is managing well. This appears to be to have a lot of growth remaining. Okay, so is your guess, and your guess is as good as my guess, how much further it will go up. On a personal note, what I think is it will at least go into the tens. So at worst, we are halfway through the bull run. At best, we could be 1/3 to 1/4 the way through a bull run. So there's still ample steam left. And I'll share with you why I have this gut feel afterwards, because there are many different factors at play in the market, many different factors that affect how the market should pan out. Okay, limited GLS supply. Okay, government land sales, it means GLS supply should signal greater en bloc interest by developers. Okay, as we can see here, there are 4 lines. It may look complicated. It isn't. Don't worry. Okay, I'll explain them one by one. First, we have the blue line. So the blue line indicates unsold supply, excluding ECs, executive condominiums. The blue line is obviously on a downtrend since 2019, downtrend going down. The unsold supply currently is about 21,000 units unsold. And 21,000 units typically take about 2 years to sell out, which is a very short time frame. And you may suddenly be left with, whoa, there's no new supply on the market. Everybody may turn to the resale market, or there may be a frenzy on buying up this remaining 21 unit once the media catches on to this and starts reporting in that way. Okay, but I don't think so they will do that. Why? Because whatever they report should not cause panic in the market. Okay, so the green line is pipeline supply, total supply that's coming up in the market. Sold or unsold, everything's in there in the green line. Okay, this one, the green line. The yellow line is the property price index, which we covered earlier. So you can see a uptick in the past few quarters. And finally, the red line. Red line is the potential supply that the government wants to release. Confirm GIS sites, that means they will release it no matter the bids. The en bloc sites that are on the market currently. Okay, these are all in the potential supply category. And usually when we see unsold supply dropping and we see the property market index going up, government will usually increase the amount of land for bidding. But this time round, they have not. Okay, why do they increase it when unsold supply is decreasing and when prices are going up? To moderate the growth, right? Because once people know there's ample supply, they will not rush to buy. There will not be such a panicky situation. So currently we can see that, hey, there isn't an uptick in the red line. So what's happening? Why is it that the government isn't increasing land supply by a lot more? Well, this issue is the tight construction labor issue. Okay, we know that the India-Bangladesh situation is quite bad for COVID, and as of now, workers aren't allowed to come in. As a result, even if you release more land, you would have to contend with fighting for labor, and labor costs have gone up so much. So no matter what, even if they release more land or not, construction costs will go up, right? Because construction costs plus land costs and plus the other peripheral costs will give you the ultimate price of the developer. So it makes up the ultimate break-even price, and and so on. So in this case, releasing more land might not be helping the situation, but not releasing land is also causing the situation to be rather tight. The supply of new homes, unsold homes, to be rather tight for the next few years. So I would say the ministers are probably between a rock and a hard place. Either or is a difficult situation to manage. Okay, low supply of completed private homes against record MOP upgraders volume. Okay, these are two different factors in one chart. So first we have the blue bars, right? The blue bars refer to the MOP Hdb flats, people who are eligible to sell, okay, in that year. Okay, listed below. And the estimated completed private home pipeline, the number of units being completed every year. Okay, so as we know, the current market is being driven a lot by upgraders and genuine users. And you can see from here, okay, this was when the peak of supply was, okay, completed homes. And in 2016, there was not so many completed MOP flats. Okay, but in 2019, okay, mainly this year, 2019 onwards, you can see that the number of MOP flats exceeded the supply of completed homes by quite a wide margin, by almost 50%. Okay, in 2020 here, we can see it also exceeds by probably about 30%. In 2021, where we are here, okay, it exceeds by probably about 40%. And next year in 2022, it exceeds by also probably about 40%. Okay, of course, not all MOP flat owners will sell their HDB. That's not what I mean, because the MOP flat owners could stay for life in their house for all they want, right? But a lot of them would do so, because MOP owners, by and large, are younger generation people who have aspirational needs to upgrade to a condo, to have facilities, to have a gated community. They want to grow their wealth in the private market, which is less controlled by the government policies. And as a result, many of them would contemplate or upgrade right away, or contemplate in the next few years to upgrade. So whatever you see in 2019, right, in 2019, and some of the upgraders could be upgrading in 2020, 2021, 2022, and fewer demand for the next few years. But the problem is completed homes are not that many in the next few years. Why? Obviously, we know construction delays, right? Labor issues, the market shutting down and starting up, the economy shutting and starting quite frequently, and unpredictable uncertainty. So as a result, okay, over the next few years, what I predict, okay, what I forecast is that we should see high growth, especially this year, 4 to 6% increase in prices. In fact, well, this year alone, in the first 2 quarters, they are already 6%, almost 6%, right? So in 2022, it may be another 4 to 6%. Well, if the government doesn't pop the party, okay? In 2023 to 2024, although then there's a shortfall of MOP units to supply completions, but I think that all this overflow in the past 4 years would still push some growth, some flow over growth into the 2023 and 2024 period, okay? And in the further years, 2025, 2026, 2027, for now, is a question mark. Likelihood another 2 to 3% growth per annum. Why is a question mark? Is because it's still supply dependent. It depends on how much of our land currently launched, because it takes about, at least in this market, probably 4 to 5 years at least to build a new condo. Okay, so it's dependent on when the workers can come back. It depends whether there are further delays allowed by the government, because government has given a lot of extensions to developers too, to complete their projects. Okay, so the next few years, I see further growth prospects. If you add all of them up, it's in the tens, yeah, to probably about 18% to 20% max that I see. Okay, it could be higher because I'm, if the government allows it to run a bit longer. But all in, these are all driven fundamentally, and I see that there's a very high chance things will go up rather than go down. Okay, so unless GLS and en bloc supply picks up a lot, government starts to release a lot more land, en bloc also starts to go through, and then construction pace resumes normalcy, then we might see that some growth taper off in the later years. So as of now, from 2021 all the way up to 2025, I see the markets going up. Yeah, reason because it doesn't appear to be solving, COVID situation doesn't appear to be solving itself soon. Okay, so in the past 10 years, there's this average supply every year that comes out. Okay, completed supply. So pre-COVID, 14,090 units per annum was the average. As we can see here, there are still shortfalls for 2021. Okay, if there's any surprise why the market started to recover since 2017, apart from en bloc, apart from developers' interest, right, is also because, right, there's a shortfall in completed supply. This shortfall, okay, the shortfall towards the average of 14,000 units, right, means that more people are fighting for less new units in the market. So when that happens, of course, sellers will start to sell higher at the price that they want. Okay, and we are likely to see this carry on even in rest of 2021, 2022, 2023, and 2024 are just marginally more than the average. So they will just make up for whatever is the shortfall in the preceding years. And of course, 2025 is a huge gap as of now because of delays in completion, delays in land tenders, and so forth. So given this symptom in the market, and you can't speed up construction, right? Even if you like it, you can't speed up build a building within 6 months. You just can't do it. So there is no way to solve this short-term supply crunch. And demand is still there. It's not like, demand has dried up. Okay, so an overview of the market segments, just to let you know where prices roughly are for the new ones, the resale ones, so you know what you're looking for when you go out, how not to overpay for something also. Okay, so in the private non-landed outside core region, okay, so condos outside core region, they are generally around here right now. Okay, they're generally in the 1,400 plus to 1,500 mark. 1,400 mark to 1,420 mark. Okay, so yes, prices have climbed up quite a bit. Yes, it is not like last time. Long ago, we have had missed a lot of good deals. If you were sitting on the fence, you sold early. Well, I did. So we made mistakes, right? But the past is not going to come back. It's unlikely to come back because prices keep going up. Okay, inflation keeps adding costs to everything. Okay, so in the rest of central region, okay, this is where we are at. Roughly 1,008 per square foot today, the rest of central region. Okay, the other bars are just volume, so we won't cover that in this talk. In the core central region, prices are somewhere here. Okay, so they're somewhere here, 2,440, 2,450 mark. So averagely, if you go out there, you'll see something around this price range. Anything below that generally have a higher margin of safety for you. Of course, dependent if you are buying a resale, a very old unit, then of course, you have to use your own discretion or seek your Navis agent's advice. Okay, for landed properties, currently this is where we are at. It's about 1,000 to 1,001 per square foot. Okay, outside core region, places like Seletar, Yio Chu Kang, Changi. Okay, averagely, right? So rest of central region is approximately 1,006 per square foot for land. Okay, and the core central region, prices have escalated quite a bit. We can't see it from here, but it's the end of the chart. So it's around 2.5 per square foot for core central region landed properties. Very sought after, and well, is as you can read the papers recently, many tech entrepreneurs have been buying GCBs, buying penthouses, large properties. Okay, because once again they can't travel. Now, in the past 1 year, just for interest sake, in the past 1 year, new condo sales have gone up by 17%. Resale, on the other hand, has fallen, although overall across the board, right, it has gone up. But because of there was an anomaly in these months. So in these months, it brought down prices. So overall, in the past 1 year, resale is minus 8%. Okay, but if sometimes the time frame you take, the moving time frame that you take also affects the result. So you have to know overall resale market is still very strong. It's still picking up. Most people are selling at a profit. So even rarely sellable, unsellable units are getting sold. So if you do want to put your property on market, this is a window for you, especially if it's an older apartment, right? Something that's 20 over year old and a leasehold tenure. You might want to consider putting it on the market so that you can move on to a newer one or a better asset with growth potential. Okay, later I'll share with you about tenure decay in condos as well. So just stay on. Okay, executive condos are currently around the 1,100 mark and climbing. Okay, so ECs are supposed to be affordable. Well, according to the government, at this price, they are affordable. So at 1,001, they are affordable. So it is not easy for condos, the full private market, to go below to a low 1,000, 1,001, 1,002. So whatever in the market that's going for 1,000, low 1,000 plus, and is a full private home, right? For brand new ones, are generally priced very well. Okay, so I'll just get a drink first, and we'll talk about opportunities in the second half of 2021. Some things that you can look at, you can consider, okay? Some investment ideas and strategies for you. All right, so projects with growth potential due to the impact of upcoming launches. Okay, as we know, new launches and upcoming ones impact the prices of the neighborhood and current launches. So why? Because people tend to compare. If this is that price, then why not I buy the other one? So people tend to compare. Without comparison, any price is meaningless, because we compare and we know what is cheap and what is expensive. Okay, so where are the areas with potential price increases in the second half of 2021? There are some projects that are already on the market that's been selling for a while. They might have seen slow and steady sales so far, but when these new launches come up, we can expect to see a lot more people buying them, or even developers raising prices, because suddenly demand will overflow to the neighborhood or overflow to these other investment choices. Okay, so I'll share some of them with you that I spotted. Okay, so Yishun Avenue 9, there's an EC site. Okay, there's 600 units. Well, an EC. So of course, not everybody can buy them. Based on the break-even price of 1,025, okay, PSF PPR, we can estimate a selling price of between high 11 to 12. Okay, so for an EC, if you're going to buy at an average price of a high 11 or 1,002, you would see that a lot of buyers might rather, hey, why don't we look at a full private instead? And these are some of the choices on the market that are currently, they may not be right next to it or in the Yishun vicinity, but price point wise, they are very similar. So some people could consider going far out just because, pricing wise, it makes more sense for them. Okay, so for example, Roots at Transit, currently 3% sold, 1,225 per square foot. Okay, very close to what an EC is going to call for. The Essence, okay, 1,343 per square foot. Of course, we have the Ola EC that will be impacted as well because it's 1,151. It will appear cheap. Well, once the Yishun EC site is launched, okay, it will appear like a good buy once it's launched. Now, Riverfront 1,350, Parkwood Residences 1,323 PSF, the Jovel 1,273. These are some of the projects that may benefit from it. Of course, the list is not exhaustive. If you would like to have more choices, please contact your Navis realtor, because we have provided them with a list of projects with different factors and a checklist of whether they are good or not so good investments. Okay, so look for them for that. Tengah Garden Walk EC, 615 units. Likewise, because they are an EC that is going to be priced around 1,2 plus per square foot, we would see all these similar launches in this price point. Okay, they will see higher demand or we will see developers increasing prices by then. Okay, so some of them for your consideration. Next, we have Tanah Merah Kecil, a piece of land next to the Tanah Merah MRT. Estimated selling price is around 1,900 mark, 2,980. The break-even price alone is almost 1,006. Okay, land costs, construction costs, and all the professional fees. Okay, so projects that may benefit from this will likely be Park Como, a freehold launch that is currently 1506 PSF. Okay, Seraya Residences, 1581 PSF. Infinity at East Coast, 1871. Okay, Penrose, okay, Penrose, 1595 PSF, and the Woodley Residences. Okay, why? Because this is a residential with first-story commercial, meaning it's a mixed, integrated development. Okay, it's not a full integrated; it's just first-story commercial. But if people are going to pay 1,009 plus for not a full integrated one, they might want to go towards a full integrated one like Woodley Residences, which is priced around 2,000 per square foot. Okay, just a little bit more and in more central area. Okay, Northumberland Road in Farrer. So you may see that projects that benefit from it are the following. You can see 1959. Okay, Uptown, Copa and Newton. Personally, this is a very good buy currently. This is a price at a very attractive price and very likely to move fast in the next 2 quarters. 4th Avenue Residence, 2283 in Bukit Timah. One is at Newton, one is at Bukit Timah. Versus Farrer. This is Farrer going for around 2,200 per square foot. Yeah, just a little more, you are at Bukit Timah. Just a little bit more, you are at District 9 Newton. So most people will start to compare and of course prefer the choice of being in town. Okay, 5 Derbyshire is 2,003 per square foot near to United Square. Once again, Woodley Residence at 2,000 per square foot. Okay, Avenue South, 2,000 per square foot, lower than Farrer, and also the Landmark in Outram area. Okay, so these are some launches that should be positively impacted, whether developers raising in price or you see higher demand. Usually with higher demand going there, developers will raise price because at different phases, if they see high demand, they start to increase their pricing more aggressively. Okay, the very famous Ang Mo Kio Avenue 1 site, everybody should be telling you about them by now. Well, why? Because the break-even price for this launch is 1,822 per square foot estimate. It's bidded by UOL. Estimated selling price is in the 2,200 plus range, which is going to be very high, record high for Ang Mo Kio. Okay, a mature town, no doubt, but well, 2002 is a record high. And of course, there are a lot of launches that will benefit from this. Almost everything in Singapore possibly can benefit from this, okay, just by comparison's sake. But for the top few choices, I would still recommend Woodley, Copa, 4th Avenue, because they will see a lot of value once people start to compare and start to buy into these projects. And furthermore, there are still a lot of units left, so there's potential for further price increment in the later phases. All right, so you can talk to your Navis router once again to check out these projects. The next thing that you can do is to invest in high MOP upgraders district. Well, some of you may prefer, to say I would rather invest in a 3-bedroom at 1.5 mil. But 1.5 mil to buy a 3-room is very difficult in town, right? You can't get a 3-room in town. So how about investing in other areas? That means in the outside central core areas where there are generally more MOP upgraders. It's also a possibility. And this gives you a safer exit in the future. Why? Because there are bound to be Hdb upgraders every year. Good or bad market, Hdb upgraders will upgrade. There will still be new Hdbs being released by the government and new MOP upgraders being allowed to buy every year. Okay, so this is an angle that you can look at because so far, based on correlation, a study that I did, you can see that the number of MOP units, generally, the higher that it is, the more property price index grows. The lower it is, the less the private property market grows in the area. Why? Because people tend to buy in areas closest to them. Why? Because they have roots there. The schools are there, their parents, in-laws' place are there, they're used to the amenities, They are used to buying to where the markets are, transportation options, and so on. So generally, people will buy near to where they are. Okay, so of course, it's not 100% correlated. In certain areas, for example, in Clementi, although there were very few units MOP, prices in the private market climbed a lot. Okay, and the reason why, well, I can attribute it also to the fact that Clementi attracts a lot of different districts people, given that it is a university town. There's a lot of good schools in the neighborhood. There's a lot of demand there, and people would flow from Bukit Batok, Bukit Panjang, even Bukit Timah towards the Clementi area, or Jurong towards Clementi. So some areas might be hotspots for attracting other districts. And as a result, even with a low MOP number of units, the property price index could go up. Otherwise, generally, if you look at areas like Admiralty Woodlands, with a low number of MOP supply in the past 10 years, you will see that property prices don't really go up. In Chinatown, the low number of MOP supply means that private property prices don't really climb a lot. Okay, in Toa Payoh, okay, in Toa Payoh, Balestier, 1470 units the past 10 years, 19% growth. Bedok, Changi, okay, sorry, Bedok Upper East Coast, 236 units. MOPs, and then we only have 8% growth. And Jurong, 1,006 units, 18% growth. Not a lot for 10 years. Okay, why not a lot? Well, at least you should be looking at a growth of 2.5% per annum. Okay, at least. Why at least? Because if you place your money in your CPF OA, right, you at least get 2.5%. And it's risk-free. There's no risk to you. So if you're going to use your money, your funds to make it work for you, you're going to put it in the property, you want to make sure your property gains at least 2.5% to break even, right? Anything more is a bonus, but at least 2.5%, or at least getting you good rental to cover that. Okay, so there are also estates with their projects that will enjoy this high MOP volume, and this is a way for you to consider to purchase with an investment. Okay, with this horizon in mind, this time horizon in the future to sell to MOP upgraders. Okay, all my figures exclude 1, 2, and 3 bedroom flats. Only 4, 5 room executive flats are considered. Why? So that we are more conservative, and also because 1, 2, 3 bedrooms, not so many of them might upgrade to a condo next. They might upgrade to a 4-room or 5-room flat next first before they jump into a condo market. So to be fair, we don't include supply in these smaller units. Okay, so if you're keen to invest this way, well, in the next 8 years, from 2022 to 2030, you will find that the most number of MOP supply is coming from these few areas. So you will see Punggol, Sengkang, Hougang. Okay, so the condos, resale condos, if you're really interested to buy those resale condos, or even the ECs, they are attractive, or even the new launches, they will at least have sufficient MOP upgraders who will buy from you. Okay, in such areas, usually you don't see foreigners buying. It's all about local upgraders and people who really need a home. Okay, the next one will be Yishun, Sembawang. Okay, 11,000, also quite a few. Pasir Ris, Tampines. Okay. Bukit Panjang is also high. Okay, the D23 neighborhood, a high number. And furthermore, with the development of Tengah area, there's going to be much more upgraders in the future. Okay, but as of now, we only have data up to 2030. Clementi, although it's 1,770, right, is likely to also be a beneficiary. Once again, why? Because the Clementi neighborhood attracts a lot of people from different places. Okay, so take note, however, that the high number of MOP supply can bode well for the private market, but may not bode so well for the HDB market. All right, so it is both a blessing and a curse depending on which side of the fence you are sitting on, right? So resale HDB in an area where there's a lot of supply, like Punggol, Sengkang, Yishun, Pasir Ris, Bukit Panjang, and so on, you'll find that in the future, it may be harder to price it to sell at a higher profit because a lot of your neighbors will be selling also. Okay, so if you're an owner of a flat in these areas, you might also just want to be more cautious that, hey, maybe I should sell it if I'm making a good profit now and move on to private properties in the neighborhood, because there's still further growth potential versus waiting out for other MOP supply to come on market and compete with me for the same buyer. Okay, So for a list of projects that will benefit from the upcoming MOP supply, once again, you can refer to your Navis router. We have provided them with this list. Next, an option for you, if you already hold multiple properties and or a couple of leasehold projects, right? You can think about recycling capital by exiting your projects with low growth potential, and you can scan them, okay, or you can ask your router to scan them for you, and then see whether there's any more further growth potential, and whether you should hold on to them or sell them right away. Okay, so example number 1. So this is using our Navis software analyzer with data sourced from Indices as from our Singapore Land Authority, okay, official data. This is just one of the project comparison for Lilydale. Okay, so Lilydale against the broader index of Yishun Seletar, so D27. As you can see in the past 5 years, okay, the Yishun Seletar area has grown by 37%. All right, and this is just resale. I'm not comparing new sale to Lilydale because that would not be a fair comparison. Something brand new with something that's many years old. However, in the same period of 5 years, you can see that Lilydale, okay, has only grown by 4.52%, which is underperforming the general index or the general district trend. So is it a good idea to hold on to this property still? You have to consider, because given that in such a long period of time, there hasn't been much growth in prices, there are chances that this property would stagnate or decline in time to come. And you might want to look at cashing out to reinvest in something that has growth potential. Okay, barring, of course, once in a while there's an outlier event. Outliers, who knows why they are priced so high? It could be a very, very renovated unit, an illogical buyer who just loves it and buys at any price, or even a non-arm's length transaction, probably selling to their family members and they just happen to sell at a high price as a gift to their children or their parents. It could be. Okay, so this is one example of a property that hasn't performed as well. So do not generalize that all properties will perform well in a bullish market. It may not be the case. Okay, so you may want to review what you have on hand. Again, talk to your router to find out whether you should be holding or selling a property. Okay, now next one, we have also comparing resale in District 16 to Aquarius by the Park. Okay, this is another project in the area. We can see that Aquarius has only grown by 5.62% versus the general index that has grown by 25%. Once again, if the market, and in the past, from 2017 all the way up till now, it has grown fairly much. But in the recent years, you can see here it's grown fairly much, but in the recent 2 years, it hasn't grown a lot. It's more like a sideways moving market. So perhaps you will want to reallocate resources to another better property with growth potential. All right. Example 3. Okay, this is for Icon. Icon is used to be one of my favorite projects. I really like it. The loft is very beautiful. But however, with age and competition, and I guess in this current market too, okay, you can see that Icon against the resale properties in District 2 hasn't been performing very well. Over the past 5 years, instead of performing at 27%, which is the industry average, the market average in the area, it has dropped a little bit by 1.85%. Yeah, so perhaps it's age, perhaps it's demand, but if you're holding a property like that, you might want to look at moving on to another property nearby. If you do want to cash in on, say, the Greater Southern Waterfront growth story, right? You may want to cash in on something newer around that area. So why do these projects have low growth potential? That's the question, right? You also want to know, why is it this way? When the market is doing so well, if you happen to be owning such a property, you will be asking your agents also, what's the issue? Number one, usually due to aging tenure. So an aging tenure turns away buyers, more and more buyers, because it's becoming a more glaring issue in today's market. Why? Because government, Singapore is still a young nation, right? So as we age, we start to see more and more properties reaching their end of life or midlife. So midlife crisis. Midlife crisis for the property. No, but because of the ballast table. Okay, ballast table is a table that's referred to commonly by our master planners, URA, SLA, and because of depreciation, right? 99 years, obviously, if you have only 60 years left versus a brand new 99 years, you wouldn't get the same amount of growth. Yeah, or you wouldn't get the same amount of value out of it. So a valuer has to price sensibly when they view your 60 years remaining tenure property. All right. Second, it could be a lack of demand in the neighborhood. As mentioned earlier, there could be a low MOP volume in the neighborhood. When there's low MOP volume, this could result in no one taking up the property, even though you're priced very sensibly. But, well, there are just not enough upgraders in the market. People are moving out from the area, for example. Okay, third, it could be too high a price quantum. Okay, because all properties generally are very big in size. So for every dollar of PSF, it climbs in price, the quantum is very, very high. The quantum becomes too much for most buyers in that market. So then people might turn to a new launch because it's a smaller size, more affordably priced, and importantly, they pass a TDSR. They can get a loan for it, and they have sufficient CPF usage and cash for it. So older properties that are too large, generally, you might also see an issue having growth. Unless, of course, you see there's en bloc potential, or there's still some attributes that are favored, okay, by the buyers. Now, in current market, the delays in construction, okay, this part, the delays in construction are fueling prices even in stagnant and declining properties. So, for example, certain places are older properties, they have been sideways for a while. Their pricing haven't really broken through or went up or down, or just have been staying stagnant and declining for a while. And because currently there's delays in construction, buyers who need a place fast are buying from these owners. So you can also check out some properties, some trends. If you see that, hey, these properties did not see much demand and a price appreciation in normal market years, such as between 2017 to 2020 first quarter. Okay, if it's only sideways moving, and you only see that, hey, wow, it starts to have demand in Q2 2020 onwards. This is usually a result of the COVID situation, and it's good for you if you're an owner of such a property. You see, yes, finally, it's appreciating. Yeah, please do not wait until it's over and starts to come down. Why? Because likelihood that once once we open up our economy and once the construction pace resumes, you would see that prices may decline again, because then buyers have a lot more choices. They can wait 1 or 2 years. There's certainty to waiting 1 or 2 years, rather than now the uncertainty, maybe I have to wait 4 years, 5 years, and I can't get married and settle down in the new place and so forth. So take this as an opportunity to cash out, okay, if you are finally seeing some growth in your property that's been stagnant, okay, and move your property into something better. This is called active managing of your capital. If you are passively managing it, just buy and hope for the best, right? And then your lease is decaying, and for some other reasons, there's just no demand there. At the end of the day, you are the one who will suffer. Okay, so actively manage your funds. Don't just wait for things to happen. Yeah, wait for the market to climb. It may not. Okay, next, exiting HDB flats with low potential. For those of you who have a HDB flat, who are staying in a HDB flat, or you keep your HDB flat for rental, take note that your rental, if your property has appreciation potential, that's good. But if your HDB doesn't have much appreciation potential going forward, you might want to move the money out of it as well, to move into something that makes money for you, because you're locking in a few $100,000 into the HDB, and if it doesn't pay you enough to hold on to it, you might as well move on. Okay, so this generally applies for areas with aging flats or high supply of new flats, which once again erodes your profit potential. Okay, so the growth rate for flats that are 6 to 10 years old. Okay, we start from 6 to 10 years because obviously before 5 years MOP, you can't sell it. So there's not much growth potential to talk about. Even though there's growth, you can't sell it. So for 6 to 10 years old HDB flats, we generally see a growth rate of 1.56 per annum growth. Okay, so contrary to popular belief, right? At MOP, it may not be the best time to sell. Okay, because there are other years that reap you a higher growth. Just that, of course, if you don't sell and you upgrade, you can't upgrade to a next condo, right? Without incurring ABSD. That's why people still do so, because they rather hold a condo that makes more rather than a HDB and wait for the years, the later years to make more money. Okay, so 1.56% growth per annum can be expected for those in the 6 to 10 year range. The source is from SRX, by the way, in case you want to check it yourself, SRX Analyzer. For flats between 11 to 15-year-old, we see very high growth rates. So if you are holding a flat that is reaching its 11-year mark to 15-year mark, is it still okay to hold on? Yes, I would say you don't have to urgently sell it off because the next few years are likely to see more growth in prices for your flat. Okay, so 4.52% growth is good because it's above the CPF accrued interest rate of 2.5% when you use your CPF funds. And of course, at least this helps you to have a positive return when you finally sell the place. You won't have a negative CPF sale issue. In the 16th to 20th year, we see Hdb Flats not doing as well, 1.35%. So if your flats are coming to the 16th year, to the 20th year, you might think about, hey, maybe I should move on to something that can grow more for me. Inflation itself over the past 10 years is 1.8%. Okay, so if your flat is only growing at 1.35%, you can bet your funds are not working hard enough for you. You will find it harder to retire comfortably. You will find yourself having to work harder so that you can compensate for inflation. Okay, so next. Older flats, 21 to 25 years. Generally, growth is about 0.26%. Okay, we can see despite the recent 1 year of growth, very steep growth because of well, the economy, people can't travel basically, and they are buying resale flats. Okay, they are also recipients of the grant, the September 2019 Hdb grants. They are now released to the market. So although we may see higher growth in the next few quarters, okay, but there's a likelihood in the long term, longer term, a mean reversion will happen. Mean reversion means that older flats will still not grow as much as usual. So you can take this chance to cash out. Flats in the 26 to 30-year-old category, you can see that their growth is minus 0.62%. So generally, they are falling in price. Okay, so it will be wiser to move on. And of course, I'll just sum up the last category, 31 to 40-year-old flats. If you're getting a good rental return, it has to compensate for depreciation because it's depreciating generally at minus 1.52% per annum. Okay. So if you know of anyone or your, sometimes even parents who are holding on to a flat because to them it will always grow, take the chance also to share with them that it may not always grow. All right. It's time to look at your options. So for a summary, the best years in a flat sold, right, are between this age 11 to 15 years, followed by the 6 to 10 year, not the 5 to 10, 6 to 10 year, followed by lastly the 16 to 20th year. Okay. So from the 20 to 30th year mark, you can see average returns start to drop. Okay, below our average inflation rate and CPF accrued interest rates. Okay, then of course your 30th to 40th year mark, depreciation starts to increase. All right, optimal growth years. Similarly, for those of you who are owning a leasehold condo or interested to buy a leasehold condo, you want to know which years should I buy? Should I buy something so old, a 30-year-old leasehold condo, a 20-year-old leasehold condo? If you're holding on to it already, you want to know whether I should carry on holding on or I should sell it off. Well, this might give you some answers. Okay, first off, which are the years of growth for a 99 years leasehold condo? Okay, by and large, okay, averagely, you will see over the past 10 years, brand new sales, okay, prior to TOP, they make the most at 6.29% per annum growth. Okay, for brand new sales, they are above CPF accrued interest, of course, and your return. The sub-sales market, because you want to know if you buy brand new and you sell before it TOPs, do you make money? Yes, in the past 10 years, we can see that it is a 3.7% per annum growth. Okay, past 10 years. Now, upon TOP, does it mean it's the best time to sell? Not necessarily. First, upon TOP, well, there are a lot of units on the market for sale at once. Okay, supply increases. At the same time, we also have to take note that in the past 10 years, it has gone down by 1.27%. So your best years to cash out, to buy and cash out, is actually by TOP date. Okay, or just after TOP when you cash out. then you might get the best capital growth. Following that, in the 6 to 10 year of ownership, okay, is 1.83% growth per annum. And then in the 11 to 15 year, a lot of growth per annum, 5.49% growth. So if you're going to buy a resale condo, for example, a resale leasehold condo, you can buy something that is 5-year-old, 6-year-old, because the likelihood if you're going to buy and stay in, you're going to stay for 8 to 10 years at least. So by then, you can enjoy the 11 to 15 year old period of growth, capital growth, which is the most according to averages in the market. Okay, so the best time to buy is also not to go beyond the 15 year. If you're buying something that's too old, 16, 17, 18 years old, 19 years old, there could be an issue where growth starts to drop. Okay, you can see the 16 to 20th year growth is only 1.39 per annum. The 21st to 25th year is lesser, is 0.27 per annum. Okay, so when you buy something too old, because it's cheap can get cheaper. All right, so just be very careful. Cheap can get cheaper. There's also a reason why it's cheap. Okay, some people are looking at certain reasons why they're not buying it, and because the next buyer who buys from you, if you stay in it for 10 years, is going to buy a property that's remaining with less than 70 years of lease. They might not be willing to pay you a premium as well because, you know, tenure decay affects them. They're afraid they outlive the flat, they outlive the condo, or they can't use enough CPF to purchase it. Okay, from the 26 to 30 year old, for 99 years flats, it also grows by 0.97 below CPF accrued interest. And finally, we have the last category, 31 to 40-year-old capital growth, 1.33% growth per annum. Okay, so why is it increasing towards the end? Why is it not decreasing? Why? Because this category of homes from 31-year-old to 40-year-old generally have more en bloc potential. So during years of en bloc hype, right, you can see a sudden spike in pricing. That's the reason why. Speculative buying. Okay, so this is a summary of what I mentioned. So I won't go through it anymore. So just take note that tenure decay can increase its impact as your property passes the 15-year-old stage. So try not to buy something that is too old. Yeah. So cheap can get cheaper, and you must find good value. And for that, right, our people in Navis have been trained in property wealth planning, and a lot of what I shared with you are just a broad overview for very precise steps to identify low risk, high profit potential properties. Okay, you can speak to any of your realtors, okay, who invited you today. So there's a 7-step framework we apply towards finding the right property. So of course, there is no way for us to find a property that guarantee will profit, guarantee will make money in 10 years, 15 years. It depends on too many elements. But what we do in the 7-step framework is to help you to mitigate risk, to look at potentially who you can sell to prevent you from buying at an overvalued price, to look at blind spots just in case you are buying into an area that you are so confident in, but you didn't know that this neighborhood might not have sufficient MOP upgraders to buy from you in the future. All right. So this framework is the more checks you have, the safer the property. Not guaranteed, because no one can guarantee you anything. Okay, no one can guarantee you a profit. Now within our shortlist also, these are some samples that you can also approach your realtor to get it. So top projects with growth hotspot within growth hotspots. Okay, so we sort by different columns, and we have important factors to look at. For example, in this case, we have the URA growth hotspot. You want to be buying in a growth hotspot because that's where government will be releasing more land. There's a lot more excitement and hype coming up. Developers will be buying and building new amenities, malls, attractions, entertainment over there. So it brings up prices in the area. Developers' profit margin can also tell you whether they will be increasing price in later phases, because the different strategy they apply, loss leader strategy, for example, may result in higher prices in the later phases. Then you make a profit as long as you are one of the earlier buyers. Okay, and of course, walking distance to MRT and a few more other factors that you can approach them to talk about, and they can help you shortlist something according to your budget, according to your requirements. Okay, so we have a lot of lists like that from top projects within 10 minutes walk to MRT. Okay, to those that are with the thinnest profit margin of for developers. Okay, so do check with them for finding a good property for yourself. All right. Okay, I'll just skip all these freehold CCR projects. Okay, you can get this for them because I'm running out of time. So in summary, I just want to let you all go because it's also almost 1.5 hours. So thank you for staying with me for most of you. I hope this has been useful for you. So in summary, these are some other areas that you need to know about so that you are convicted whether you should be investing more, taking more risks, right? Taking more risks with your money, or you should remain very conservative. So from what we see, there is still significant room for capital growth. As of now, the entire private property price index, right? We have grown by 17.5% in the current cycle. The previous cycle was 63%, all right, in 2009 all the way up to 2013. The previous cycle from all the way from 2003 to this peak was 60%, and the previous one after the AFC was 39%. So currently, we are still far from the growth prospects of the previous highs. Of course, we can't predict that it will go the same, but there's a chance it will go up more than go down. Furthermore, we have to understand that the government does not want the property market to go down. When it goes down, what happens? A lot of our retirement funds are inside our property, right? So if it goes down, what happens to our retirement funds? What happens to our parents' retirement funds? What happens to the sentiments in the market? People who are depressed when their property values go down will not be spending as much. Property prices being down creates a spiral effect where developers will also be hesitant on bidding for land. They will also be hesitant on employing more people, growing their business, bidding for more land bank, and so forth. And it all has a negative impact on the market. So it's very likely that the government just wants to see a steady climb. As long as it's steady, they will let it run. They will not want to collapse it. And furthermore, it's also a statement put out by the ministers. They do not want to collapse the market. They just want to see moderate growth. Okay, second point I want you to note is that back in the previous cycle in 2017, okay, in the previous cycle in 2017, Q2, at a point where unsold supply was 15,000 units, okay, unsold supply 15,000 units. That was when for the following quarters, a lot of developers were heavily bidding for en bloc supply, GIS supply, because they knew in less than 2 years, there will be no unsold supply, and whatever they have on hand is going to be increasing in value. They can earn a better profit margin. Definitely there's demand, people will buy from them, and it's very safe to enter. At present, we are at 21,000. Our unsold supply is 21,309 as of last week. Today, I'm not too sure how many it is. It could be 21,200 or 100. But we are very close to this previous mark of 15,000, 6,000 short. And developers this time around should be a lot wiser also. They are a lot more, they are a lot more forward thinking. They do not want to wait until the supply has dried up too much, too obviously, where every developer is bidding and they come in to bid at the same time. Then they would find it hard to win land bank. All right. So we are not too far from this resupply mark, and very, very likely we'll see the new renewed interest by developers very, very soon. We have already seen some of them started out since late last year for going for en blocs and going for GLS, but we expect to see more in the coming few quarters. Okay, unsold supply, as I mentioned, decreased, now 21,000. And there's also ample extensions of time given by the government to extend completions. So take note that developers are not under any urgency to sell out because they, by and large, are okay comfortably without much of ABSD or QC penalties looming on them. So there's no urgency for them. They're given ample space to sell because this is this is an event that is an act of God. So the government is not penalizing them for not completing on time. Thirdly, construction costs, inflation in various segments that I mentioned, these are all in the news. I just made it easier for you to understand what's going on concisely. Okay, wages have already climbed 15 to 30% in construction sectors, and all these are adding on to your construction costs. So in the future, it's very unlikely that costs will suddenly drop very soon. It's likely that this will be sustained because of compliance with the COVID rules and measures to check them and so forth. And labor. okay, the entry of new labor. So there are also no oversupply issues, as I mentioned earlier. Currently, the next few years, we see shortfall, okay? We see for this year, is a shortfall of average supply to what we expect to see. Shortfall in 2022, a slight marginal oversupply, and then shortfall once again. Overall, it's a shortfall. So likelihood prices will have a lot of upside pressures. Next, as I mentioned, conservative release of land to moderate inflation. If government is not increasing a lot of land, okay, as you can see here, it's very conservative, okay? It's not releasing a lot of land. It also means that ultimately the aggressive bidding for land will stoke undersupply issues because not enough completions happen. And also, developers will be all focusing. There's a lot of buyers, only that few plots. So this will stoke undersupply issues and price pressures upwards once again. Okay, and in case you don't read the global news, you don't see what's happening on a broader aspect, right? Just take note, around the world, this is already happening. All right, whether it's in China, home prices growth, in UK, prices growth, in Hong Kong, in Denmark, in Australia, okay, in where else? In Dubai, and everywhere from Shenzhen, New York, and everything, and US. Okay, everywhere in the world, okay, we are seeing prices grow. Maybe some parts of the world don't, not really, some parts of the world, but most of the world is experiencing this. And if you look at the consumer prices growing once again to a high, you will know that we are going through inflation. Hopefully, it will not be too high in inflation. 2%, 2-ish% is still bearable. Anything more than 3% is really bad in the long run for everybody. Okay, so if you're not putting your money into assets, you're just putting them under your, in your in your bank account or under a pillow per se, right? It's not really ideal for you. You start losing money every year. Okay, GDP forecast. Of course, our central bank MAS also came out to say that our forecast is likely to exceed whatever being forecasted. Our actual growth is going to exceed whatever is being forecasted. So that should give you some more conviction whether to enter the market or not. Okay, 3 days ago we had Ravi Menon coming out to say that, hey, market isn't overheating now. That's a very clear sign. If you still haven't caught it, it's a very, very clear sign to say that, you know what, it's not overheated. We don't have to, we are not in any urgency to act. Okay, it does not mean that it will not be, cooling measures will not be imposed this year, because he also said that we will never disclose that in advance because it defeats the purpose. Fair enough. But you can tell from what I shared with you early on that the chances are high. It's good that he says it's not overheating now, but the chances are high. So you do not want to wait until it happens, because once it happens, right, it's sudden. It's usually on a Friday, 4 p.m. And then you see show flats opening the whole night. Saturday, Sundays, people will be, pouring over to buy properties. Yeah, climbing all over each other to buy properties. Okay, you don't want to reach that situation because that becomes a seller's market and you will be at their mercy. Okay, occupancy rates are very high, currently at a 93% occupancy with less than 7% unoccupied units. So once again, there is no urgency by landlords to dispose their properties. Okay, so overall, we see a lot of it's a time to be invested. Okay, it's a good time to be a seller and an owner of a property. Okay, so low interest rates visibility are likely to carry on all the way to 2023, as you can see from here. So this is also a clear signal that in the near future, 2 years time, you should be good. Yeah, interest rates are not likely to rise, if anything, by much. Even in 2023, when it rises, it won't increase a lot at once. It won't go up by 0.51% suddenly. Usually, they go up by 0.25 basis points, 0.25%, meaning 0.25%, 0.25%, slowly increasing it. So you don't have to worry there will be a sudden shock. And whenever interest rates increase, guess what? Usually inflation increases, meaning your property price will also grow in tandem, right? Only in a bullish market, only in a healthy economy where people are earning more, will the government increase interest rates. Because more people are borrowing and the economy is doing well, then they will increase. If it's not doing well, they will keep it low, as what we are seeing currently. And remember, historically, during this is a recap for you from the first half session, after global financial crisis, it took 10 years to recover to even 2%. interest rate, 10 years. So even if they say I will increase interest rates from 2023, could it take 10 years to recover to even 2%? Because even 2% interest rate is low, it's considered very low. All right. So if it takes even 5 years, 8 years, then you have to be vested during this period of time. Yeah, because cost of holding, cost of funds is low. You need to take more loans when cost of funds are low. And these are good loans. Property loans are investment loans, are good loans. It's not a bad loan like credit card loan that's frivolous in nature. And also know that globally, high inflation is expected. US is targeting more than 2% inflation per annum. Okay, in the past they were just targeting 2. Now their target is more than 2. So they are more comfortable with letting the inflation run above 2%, so that the economy can jumpstart itself. People can start earning more. Businesses can start spending more. In this case, and guess what? The world is also considering. ECB, the European Council, is also considering applying this. Why? Because their economy needs to be jumpstart as well. And I can tell you, when major economies do that, many other economies will follow suit. Okay, Singapore does not have a declared interest rate targeting figure, but around the world, established economies like Japan, like Korea, Australia, all the major economies have a magic number, which is 2% per annum. So you must know, when all these powers around the world are all targeting inflation at 2%, sometimes higher, sometimes lower, right? Your money is shrinking this amount every year. So you have to invest them. Do not hold too much cash. Invest in something. If you are not sure how to, find someone who can advise you how. All right? Because I know some people are naturally not inclined into investment and numbers. Okay? So to summarize, okay, we are getting to the end. To summarize, this is a 10-year comparison. It's important. If you haven't been listening in, this is where you should listen in and look at the screen, all right? 10-year comparison of common Singapore investment choices. I just updated them 2 days ago. So we have ECs in the past 10 years performing the best, all right, at 218% return on equity. Remember, return on equity means whatever you put down initially and you're getting back, okay? Of course, your initial capital of 100,000 is not possible. You don't get anything for this amount for property. What I did was to debase all the figures into the same figure so that we can compare apples to apples. Okay, condos had a return on equity of 183%. Landed properties had a return on equity of 148% over the past 10 years. Hdb Flats, 127%. Okay, your CPF made you 28%. Your Singapore fixed D account paid you 21%. Your gold, if you invested in gold, paid you 13%. Bank account, of course, you earn peanuts. If you invested in the Straits Times Index, hopefully you are not a casualty of it, because you would have not made a lot of money. And furthermore, even bonds of great companies, once great companies, can go to nothing. All right, so be very careful. If you're Singaporean or if you're based in Singapore, and you can buy a property in Singapore, it's a privilege, because in the long run, it does go up in value. It's not very volatile. As you can see, I have updated this list for many times over the years, from 2016 till now. And every time we see properties at the top of the list, and private properties especially at the top of the list. So you have a chance to invest in something that is low volatility, if without ABSD or low ABSD, with very strong forces controlling it to move upwards slowly but surely. You should. All right, you really should. Okay, buy the biggest possible that you can afford. Okay, if you adjust it for inflation, obviously putting money in gold, putting money in your bank account, and putting money even in the STI has lost you money. So diversify, and also don't just don't just take the easy way out. Okay, with your current properties, actively managing it, choose whether you should hold on, check with your router, your Navis router, whether it's time to cash out or to move on, or what else other opportunities there are on the market for you. All right. Okay, the whole process when you talk to one of our routers is very simple. There will be a discussion, of course. Step 1, a discussion to find out your plans. Step 2, the discovery is to help you to ask to find out your preferences. Okay, to recommend you solutions that can help you optimize financing and creative manners of holding to reduce taxes and so on legally. All right, I must emphasize that, legally. Solutions, we give you solutions about what you can do, the blind spots, timeline, finances, review pros and cons of all your different options, okay, until we find the best approach for you. And then we help you to identify properties with the lowest risk and highest profit potential, all right, using our 7 steps framework. And after that, our guys will, of course, execute for you and represent you to negotiate the best price possible for your investment. So this is not a simple process. It takes time. It takes your investment in our people also to work together to get something out, and so that they can give you the best advice and the best recommendation. All right. Okay, but we emphasize this because we don't want our people to just be an order taker, a buy, sell, rent agent who is not able to evaluate to you and advise you well. So this is the training they have gone through. Let them help you with your journey. Okay, there are multiple ways that our guys are trained in, and these are some of them to help you to lower your monthly installments, whether you are buying another unit or current home that you have, to acquire passive income, to lower your cash down payment, okay, to tax planning, so you save on taxes, don't pay unnecessary tax, because then you are just losing on your returns. Okay, increase your returns and obtain higher leverage where need be. So all of that, all these yellow boxes outside are the different ways that they have been trained in. You can speak to one of them, those who invited you, right, for a consultation. Okay. And finally, I will just summarize the session over here. High inflation. In the news, they said it could be transitory. Okay. It's painted by the media transitory, but transitory can also mean 10 years. Transitory can also mean 1 day, right? Transitory is a very vague form that the media wants us to know of, because, well, you don't want to cause panic in the market. Neither do you want to cause everybody to rush out to for fear of price inflation to start to buy things and hoard things, right? So, but it can be a lot longer than expected. So transitory could mean 10 years, 15 years even. And as we have witnessed, there's massive money printing by central banks across the world. It's not just US this time around. It's not just one or two or a few, but massively by almost all the banks in the world. All right. So that's the reason why we see asset prices recovering so swiftly and past previous highs. The amount of money chasing the limited quality assets issue is there. Okay. And these high levels of inflation might not be short-term transitory, despite the news, right? Despite the news, given there's so much debt being created and it's likely to be there for years to come. It's very hard to climb out of a debt hole that a lot of nations have dug themselves into. Okay, so the only method is to keep rolling it forward, roll the debt forward. And in this coming decade, as money deflates even with more certainty, it's critical all of us resist holding cash, although it feels safe and comfortable, right, to see your bank account have a lot of money, but it may not be the best idea for you. All right, what is comfortable is really good. And this can cost you 2% or more per annum due to inflation. So put your funds in quality assets. All right, Singapore properties, of course, are very likely to continue to outperform various asset classes and attract foreign funds because of our strong fundamentals as a nation, of how we handled COVID, a strong Sing dollar, and generally a very pro-business and foreigner landscape. All right, so with that, I end my talk. Thank you very much for your time here. If you have any questions, right now we'll just open up the chat group for a short while. Okay, I know the chat has not been open. Some of you might have questions, but we will allow some questions for now. So Jackie, if you are there, could you help me to open up the chat group? So I know that some of you have said that in a talk, you would like to ask some questions and get hopefully some answers, right? So This is the moment you can also ask some questions. So
okay, sure, let me do it.
Let's take about 10 minutes to do this.
Yeah.
Jackie, is it unlocked already, the chat? Okay, so if you have any questions now, I'll take a few questions. Just please go ahead to type out your questions in the chat group, in the Zoom chat group.
Yeah, I've opened it up already.
Okay, thank you. Okay, we'll give you a little while to think about your questions, if any. I'll do my best to answer your questions. If not, okay, so we have a question from Chris. Is now a good time to get an investment property? And if so, would a new launch or resale be better in your opinion? Okay, so two parts to the question. Is now a good time to get an investment property? Obviously, to me, it's a good time. Not because I'm in real estate and doing a talk, right? But because I see a lot of upside pressures, as I shared over the 1.5 hours with you, a lot of upside pressures globally that will still persist for a while. And when there's a lot of money being made in the stock market and by the very affluent, the people who are doing well in this current situation, like tech industry and certain different industries are doing well, money will pour ultimately into real estate as well. And well, as I said, Singapore's property generally is not very volatile. If the market does go south all of a sudden because of a very drastic turn of events, the cooling measures that are in place currently can easily be removed by the government one by one, piece by piece, to heat up the market. So I don't see any big issue because the government is taking care of the market. Yeah, in some places in the world, they might hate it that the market is not given a free hand. But well, I'm pretty happy that our government is very actively managing this market so that prices remain stable, moving upwards. Yeah, rather than parabolic and then you can collapse just as well. Okay, so second thing, question, sorry, I took a while for that. New launch or resale? Okay, in both the new launch and resale markets, there can be good deals to be found. Okay, just that in my opinion, because last year I bought a property myself, after COVID in August, and I was scouting for weeks on the resale market and throwing offers to a lot of owners, and it was so hard to get a good deal. So hard because you have to find the right unit for sale. The owner has to be urgent enough to want to let go to you at a good price, right? You have to determine what's a fair price for you to enter. And I couldn't get something. I threw checks out. I threw to them, and they took a few days, but they just rejected my offers. So it's not that it's impossible to find a good deal in both markets, resale or new launch. It's just that it's harder to find the resale market. And further to that, as we have seen, right, you do not want to buy something that is too old in the resale market. So that once again narrows your amount of number of properties you can search from. Yeah, so yes, you can find both if you have the time, especially to comb the resale market. But in the current market, I feel that resale owners are very, very resale owners, it's a seller's market. So resale sellers generally are not desperate to sell. Yeah, so new launch developers, on the other hand, are probably more urgent to sell than them. Yeah, so you have to see who's more urgent. Okay, for J Lim, please again show your attractive list of properties. I'm sorry, I will not show them right now because you can get the whole list from our Navis agent. So the person who invited you can share it with you so that you get a whole list rather than, I can only show you piecemeal as time is constrained. There are a lot of different categories of attractive properties. So I'm very sorry for that. I'll move to the next question. How do you identify a good resale condo with en bloc potential by Shu Ping? That's a very good question. So a resale condo with good en bloc potential, first, there is one tool that I use, it's free. You can go to go and Google this, all right? HProp en bloc calculator. You can just Google HProp en bloc calculator, right? Then you key in that condo name. They have an algorithm that tells you whether there's a high chance or a low chance of en bloc of a property going en bloc. Okay, so is it accurate down to is it guaranteed? The answer is no lah. Once again, there are certain things that the calculator can calculate, but some things you can't predict, like human nature, how much they want, human greed, how much everybody wants, or whether in the condo everybody likes to stay on and there's just no chance because the owners just don't like to sell. So and also just take note, en bloc is a very long-term game. Although, for example, in 30 years, you could be making a 40% windfall in 30 years or 20 years for the matter. If you wait 20 years to get a 40% en bloc premium, right, a windfall, 20 years and 40% is not a lot. It's only about 2% per annum. And you'll not be getting great rental along the way because any en bloc property today, most of them are older. Most of them do not get high rental returns because tenants obviously don't pay well for older properties unless you renovate them. So it may not be the best option moving forward. Okay, Charlotte, what is the difference in pricing a private property between leasehold and freehold? Okay, by and large, there's only a guideline. the guideline is about 20 to 25% more. When you compare apples to apples, two brand new homes or two homes of the same tenure sitting across each other, one is freehold, one is leasehold. Generally, it's about 20 to 25% higher for the freehold versus the leasehold. Generally, yeah. So if you get a smaller difference, is that you get a 10% difference, then you are probably getting a better deal. Okay, between Copa and Urwell, which is a better investment buy? I don't want to offend anyone, but I prefer Copa at this point in time. All right, Copa seems to me to be a better buy at this point in time. Urwell has some good units too, no doubt. But well, it's Copa for me. Okay, so is a mixed development a good buy? Kelly is asking. Oh well, it depends on the price you are buying it. So are there good promotional units being sold? Yeah, if there are good promotions, you should look at it. All right, because in the development, not all units are priced at the same PSF, right? Some are premium stacks, or some are the units, the stacks that are kept for later in the launch so that they can price at a higher price. So what is currently available, are they priced at a fair discount so that there's still increments possible when you buy into them? That's the question you should ask. That's like a margin of safety. So if it's a big mixed development, generally I'm favorable, meaning a big mixed development like Sengkang Grand, like Woodley Residences, because it is a true mixed development where people can live on top and settle everything below, from enrichment to community center to hawker center to whatever you need downstairs. But if it's just a very simple mixed development, like a level 1 commercial with a residential at the top, level 1 commercial is very limited to what type of amenities you can provide the residents. Then yeah, I'm more pro the bigger ones. Okay, so next question by user 464. 99 years. Okay, do I think more buildings like Arcadia will be taken back after the lease? The answer is well, the good thing about private homes, right? If they are being sold en bloc, there are many possible buyers, developers on the market who can possibly top up the lease because they are willing to pay that premium, and because the owners are also reasonable in their price, that they are not too greedy. But at least there's a chance that en bloc happens for and the private developers buy it. So, but is it possible that there are some areas that the government will not renew lease and take back because they have plans for intensification of land use or change of land use? Yes, it's possible, because 50 plus years ago and now a lot of things have changed. Government today, as you can see from the Tengah upcoming estate, right? Government really wants to build a lot of green space and free up level 1 land, okay, ground level land for greenery, for enjoyment, and push the roads, push transportation all beneath ground. So I believe there'll be more land that will be taken back so that they can be, executing the next plan, the next vision of our master plan. How much do I think, so this is cool from NYP. So how much do you think a 500 square feet unit costing close to $1 million will grow in 10 to 20 years? Okay, it's a very hard guess. Well, it depends on whether you're buying a unit that you're paying a fair price now. Are you buying an undervalue or at fair value now, such that it can grow further in price? It depends also whether it's a 99 years or leasehold, because in 20 years time, if it's a leasehold, it would only have like 79 years left. You know what I mean? So it's very hard to say exactly how much it will grow, but I expect it, if it's brand new, to grow by at least 25 to 30%. Given in the long term, this is so far what property prices have grown at, about 2.56 to 3% growth per annum averagely, right? Of course, not blindly buy any property, it will go up. If it's too old and property, or a property that's not in demand for various other reasons, then it may not grow so well. So just take note, this is really, it's not precise, I know, but because the question itself, we don't have time to go in depth. So I hope you understand. Mujadi. So are you the Mujadi that I know? Jackie's, yeah. Ah, hi, good to see you. Been a long while. What's the thought on demand from foreign buyers? Demand from foreign buyers currently is not very high because obviously they can't travel in and see. But after things open up, I am very sure a lot of demand will come back because of what they have seen, how they have seen Singapore perform in a crisis. And their country have performed a crisis. Not to put any country down, but there are a lot of countries that are way bigger than us, and it's a lot harder to manage the virus spread. and it's very hard to manage resources and pass down stimulus down to the man in the village. So in terms of the wealthy, affluent class of people, generally they want certainty, they want freedom and certainty. These two things. I think our government in Singapore has done that very well, and they have continued to show throughout these 1.5 years their strengths in managing. So they're managing Singapore pretty well. So I think foreign demands will return. Hong Kong demand is obviously there already. As you can see, people are getting out of Hong Kong for fear of draconian intervention from China. Apple Daily, for example, as you all know. So Indonesians, Malaysians, of course, people from other countries are likely to return to Singapore once the bubble travel bubble is lifted. Can you repeat the website address again? Well, luckily you didn't ask me to repeat the talk again. Sorry, what website address, Swee Ching? Okay, I think Jackie has given you that. Simon, there's a question. For landed investment, would it be better to get a new build for easy rental or rebuild with larger land size? Okay, so that's part one of your questions. Well, new build, easy rental, no doubt. But remember, your easy rental comes at a cost. You're paying the developer a profit margin, right? Because he obviously makes a profit selling you the property. And these days, landed developers are very, very aggressive. They price very high because they know that for you to buy a new piece of land and build, good luck to you getting labor even. Good luck to you getting an architect to help you build within, within 2 to 3 years. It's going to take a long while. So if you're going to wait 5 years to buy yourself and build and realize your rental returns in 5 years, is it still okay? Is it still worth your time? And is your money sitting idle in the meantime doing nothing? So that's the question you got to ask yourself. Okay, what's the trade-off? So once again, you got to be very precise by finding a property, looking at what's the selling cost, what's the rental, and then comparing with what's the construction cost currently and the time frame before you get the rental yield. You can compare both before you know which is a better deal. But both have its pros and cons. Okay, REITs are also a good way. So in Singapore, I also invest in REITs. That's a good question. It's a side point from what we are discussing today. But I think in Singapore, the only worthwhile investment for stocks is REITs to me, nothing else. Probably once in a while the bank stocks, but REITs. But generally, I invest in the US for better returns. So for if you have physical property, first you should get physical property because physical property goes up a lot more in terms of capital gains and give you rental. Of course, there's some managing involved. You got to manage the agent, you got to manage the tenant once in a while. But that's still bearable if you have an agent helping you. But for REITs wise, it's almost completely hands-off. It's very liquid, so I like that also, and it has good use. And of course, you don't get to invest in malls and offices so easily. Maybe more malls these days and logistics so easily. Like you do buying a physical property. So I will invest in both. But priority, if you have funds, will be a property because you take advantage of being a Singaporean or a PR at least for lower ABSD, then it's worth your while. Okay. Wow, there's so many questions. Okay, I'll try my best to answer a few more, but I may not be able to give you all the answers that you are asking for. I'll just see what we can do, all right? Is an old freehold property at Floral Drive there a good buy? Well, we have to be very precise. What's the price? Are they fair value or undervalue or not? Because Floral Drive, from what I know, isn't a major growth hotspot. Isn't an area where government is pouring a lot of funds. It's pretty mature as an estate. So there won't be a lot of new upcoming exciting things coming up. So that could be one of the ceiling, causing a price ceiling in Floral area. But if you can get a good price for it, the owner is selling at you at a kind of below valuation, then that could be a good price. Or because you need this home and you're going to stay in or you're going to rent a place and you're getting at a fair value, then it could be still worth your while because you save on rent. So you have to be, we have to be very precise again to get a good answer for you. Does an investment property have to be a small unit? Not necessarily. Why? Small units, you have to make sure that at the end of the day, when you want to sell them and you want to rent them, there's a crowd, there's an audience for you. So if you're investing in town, generally the audience will not be a big family, right? A 3-4 bedder. You can go for 1 or 2 bedders. 2 bedders generally are my preference, number one choice above anything else. 2 bedders, because out of off the cuff, I've studied a lot of properties. 2 bedders so far have given the best rental return consistently. High demand, generally easiest to rent out, quickest turnaround, so vacancy rate is low. 2 bedrooms generally are the best. And of course, if you're investing in OCR areas, outside core region areas. You want to invest in 3 or 4 bedrooms. 3 bedrooms being better than 4 bedrooms in rental yield generally, because families are usually there. Conservation shop houses like Tiong Bahru, I will find it the risk is a little bit too high because tenure is very low on that. It's still a question mark whether the lease will be extended by the government. You're hoping that some other, some other person who doesn't treat money very seriously, some other creative or guy will buy it from you at a premium in the future. If it's purely for enjoyment and you know that the risk is you losing money, then go ahead. But just be sure what's your intention and whether you can forego any exit strategy, any profit on exit. Sorry, I need a drink. West Coast, personally, I find that it's high potential. East Coast has always been pricey and in demand because of the beach. It has a very nice beach, right? Plus a lot of good food and residential areas. West Coast is a good prime area in the upcoming time. I would say Kent Ridge Residence is a great buy currently because it's very livable. It's very near to the Greater Southern Waterfront. We will stand to benefit in the long-term plan of Singapore's 15 to 20 years master plan of developing the Greater Southern Waterfront. So West Coast area is a good area. Pasir Panjang, West Coast, but you have to have a long-term time frame. You likely won't expect to exit within 3, 4, 5 years time and make a windfall. So if you are looking for something shorter term, then then area might not be so suitable. Longer term, it will be more suitable for you. Okay, Betty, your question is, when is a good time to go in to buy at a good price? I would guess that you are looking at fire sale deals, right? Last year was the year. The next one, I don't know when. If I know when, I will tell you, okay? But I really don't know when because it's hard to predict a black swan event. The issue is black swan events happen when people don't expect it, right? So only in the black swan event is there sufficient fear, sufficient anxiety that people want to cut loss and get out so that they feel safe once again. So when can we expect the market to go back to that lows? It's very difficult. And I can even say maybe you'll be just you'll be wasting time waiting for the best time. Okay, time vested in the market is better than trying to time the market because long run is a positive drift upwards. Positive drift. You stay on, you make the most. You time the top and bottom is very difficult. We can make the best guess, but we won't be able to time the bottom because at the bottom you are too fearful to take action. For most people, it's like that. Yeah, even though now we say no, if it corrects once again, I will buy. Yeah, at that point in time, most people don't dare to buy. Okay, that's the truth. So focus on finding good value in any market because there's always good value that you can find in any market. All right. So you just have to look hard or get one of your guys to help you. Is it possible to exercise a buy, purchase, refurbish, rent, refinance? Of course it is. Yes. Wirestun, yes, it's possible. Dennis, notice the freehold upside potential not as good as the leasehold. No, I do not think that freehold will break this trend in the future. I think 99 leasehold is becoming the norm, and people are generally receptive to 99 years. So being more affordable at the same time because you put 2 brand new condos side by side, freehold and leasehold. Leasehold generally will be cheaper. Yeah, almost for sure it will be cheaper than the freehold, right? So more people will be able to buy from the 99-year seller subsequently also when they want to exit. Whereas the freehold will still be selling at a higher price. So there will still be a market for freehold. Don't get me wrong. There will still be a market for freehold. It's just that I think 99 years will have a stronger growth trend for the following years because freehold will be more pricey to start with. Not a lot of people can afford it. But in the long run, the pros and cons, the freehold property doesn't depreciate after 15, 16 years. It doesn't depreciate so much. So you don't have to keep actively managing your capital, sell and buy, sell and buy, sell and buy. So that's the good point about it. Jeremiah, your question. 1 or 2 years time, I don't think prices will drop. So don't bother if you just have a time frame to wait 1 or 2 years. Please don't bother waiting 1 or 2 years. Where the reopening market actually push prices up. Reopening of the market is likely to push prices up. Why? Because the economy once it's bullish, once GDP improves, once a lot of industries start to resume, like tourism, like retail, start to resume, right? A lot of other industries start to make money once again. People will once again, you will be reading about positive news in the media. And the more positive propaganda we read, right? It's propaganda after all, right? The more people will be out there buying, right? For now, there's still some fear in the market, although there's relief. We are in the state of relief, and then optimism is coming. We are not at optimism stage yet. At optimism stage, towards the end is the worst time to buy. So you might not want to wait until then. Supply is higher than demand. Is it true? Currently, demand is higher than supply. And supply of unsold units is actually not enough. Supply of new land is actually not, is still very conservative by the government because they don't want to stop construction inflation. Because you release more land, but you don't have more workers, you have a different set of inflation coming in. Okay, reflection selling at 2.48, is it too high? Wow, that's a difficult question. I don't know the stack, I don't know the floor level, I don't know the facing. So I'm just giving you a very, very not precise answer. I just want to forewarn you. Okay, but at 1,600 plus, I do not think it's the best deal on the market currently. Sorry to say that. I would say about 1,004 for 1,004 plus, or maximum 1,005 for reflection will be more fair. All right, given the tenure that has passed. Okay, wow. I can only take probably the last 3 questions. I'm so sorry. I know there are so many questions down the line. I can only take three more. The rest of the questions, I hope you can divert them to your Navis routers to help you with them. They should have a lot of the answers because we have been sharing with them a lot of the training materials, and they have been well trained by us. Okay, so you should get a lot of answers from them. I will answer this one by someone I haven't answered before yet. Okay, Zoe. Zoe is asking, what's the potential of properties at Geylang? Well, Geylang, there's always been a speculation of all the red light activities moving somewhere far to Tuas, right? I'm not too sure how true that is. I don't frequent Geylang. Maybe Jackie would know. Just joking. Jackie is a very nice guy. He doesn't do such things. Okay, but Geylang is there's potential given its location is very good. Given that the rental rates rental yields are high, and it's very near to town, of course. But you must be careful about the tenant pool that you're getting. So if you're going to the even number lorongs and the lower number lorongs, 2, 4, 6, 8, 10, 12, 16, and so on, you'll find it very hard to get a loan from a bank. You get to get it from a financial institution like Hong Leong Finance, for example. At the same time, your tenant, if you're renting it out, questionable. So you must be willing to handle such people. Okay, questionable in the sense that not all of them are working in the red light district, but some of them might be chef, cooks, from China or from Malaysia staying there. They might be bunking in with a lot of people in one room, or subletting without your knowledge and approval. And you could have other problems to deal with, because my clients have been there before and have such problems. They have to frequently spot check on them. In the later lorongs, in the 30 plus or in the odd number lorongs, generally you're okay. So long run, will I see growth potential there? Yes, I think there is growth potential in Geylang for sure. Yeah, more and more people will be okay with red light district, because it's kind of cleaned up also after so many years. It's not so bad as before. So yes, it is a potential area to invest in. Just be very careful of going for too tiny shoe boxes, because there are really some tiny shoe boxes, 300 over square feet, not really livable, kind of hard to sell after that. Renting is no problem, selling is a problem. So just take note, don't always buy the cheapest or buy the smallest just because that's all you can afford. You might as well save a bit more to afford something better. Okay, that's easy to sell. Okay, who haven't I answered? Let me just look at someone. Okay, yeah, I'll just pick one last question. For Irwell, it's now at 2006. Do you think at TOP, or at TOP it will be 3,000 per square foot? I'm sorry, I am unable to I'm unable to guess that, but I think 3,000 is a bit on the high side to hope for at TOP. If you're talking about a longer time horizon, like 10 years time, there could be a possibility. But at TOP, if you're only investing under TOP to sell, you don't be so bullish lah. Be a bit more, be a bit more conservative. 2.6 is not a bad deal, but then don't expect it to go 3,000. I think 2.750, 2.8 will be a fairer mark to reach. Okay. So yeah, I think okay, that's we are getting to the end. I can actually help you all with probably a note with the last few questions, all right? But we might have to stop. So please do not enter new questions. I'm so sorry we have to end here. My family is also waiting for me, so I have to go soon. So which have better potential, Paya Lebar, Aljunied, or Dakota? Well, personally, Paya Lebar is a hotspot because of commercial hub that is coming up nearby. It's only a plan in progress. It hasn't been completed yet. We have Dakota as my second choice. So Paya Lebar, Dakota, and then followed by Aljunied. Okay, because Aljunied is still a bit more residential industrial. Okay. So I've viewed Galaxy is asking, I viewed a resale unit. The price was listed 950. When I showed up, start to negotiate, the agent informed that the price was wrongly listed. What is your advice? My advice is to ask you to take it easy, because even if you are right, there's no point being upset about this, because some agents deliberately misprice. No doubt, some people deliberately misprice to mislead you. But if you're going to go after them for that, I think it's a lot of a waste of time, unless you really want to get your you really want to get justice done. But some of them honestly price it wrongly, or maybe they do not update the price as the owner increased price and then they did not update. So really forget lah. So I will advise you to confirm before you go down, so you don't waste time. Confirm that's the price, and then negotiate from there, so you don't lose so much time asking. Ground facing level 7. Golf ground facing. Okay, the golf course will be moving. So just so you know, Esther, that whatever good views you have right now in the future is not guaranteed. So I would say also be a bit more prudent, since it's not a very high floor unit. About 1,005 mark might be fair, in my opinion. Okay, I hope you're not the seller, because I don't want to upset you, but my own opinion is, yeah, not to be too bullish about it. All right, we've reached the end of the talk and all your Q&A. Thank you so much for your time. Hope you guys have a great weekend. Hope it was also helpful for you. And please continue to support our Navis realtors. And they have a lot to help you too with adding value to your real estate investment and property wealth planning journey. So that's all from me. Take care, and then see you in half a year's time if you are still keen to know what the market is up to by then. Okay, thank you so much, Jackie, Gary, and Sean, for being behind the scenes supporting the event. We can end the talk now.